looking back a couple of days, the big story, the Federal Reserve really took this new framework, this average 2% inflation target to heart, put out a forward guidance that says no rate hikes until inflation gets at 2% and stays there, is in the process of overshooting as well. 2 voters dissented. One thought it was too specific and would tie hands, the other not specific enough. Where do you stand? With the majority, this is just right, or do you have any sympathies for these two views?
No, I definitely supported the decision. I thought the chairman did a good job in translating the framework into actual policy at this meeting. I think we were under some pressure to be able to show that the framework review would translate and would come into the actual policy statement. Exactly how to do that was a matter that the chairman had to navigate and guide, and we got a dissent on each side, so that must mean that got it about right there.
So you said, as a matter of fact, in an event on Friday, that you think this new guidance is going to work. It's going to help get the Fed to 2% inflation. Why? The Fed has not been able to get the inflation rate to 2% and hold it there for most of the last 8 years since it started targeting inflation back in 2012. Why is this going to work now?
I think it has a good chance of working. I think the simple version of this is that the Fed will be much less preemptive about trying to raise rates to contain inflation when inflation is below target. And or really not preemptive at all, I guess, in that situation, and instead wait for inflation to come up to the target and then exceed 2% for a while, and then try to make decisions about what to do at that point, instead of bringing in the ideas from really the 80s and the 90s, which were that you always had to be a step ahead of inflation in order to keep it under control. We're in an era where we don't really have to do that, and so I think the committee's really come to the point where we say, well, we're not going to behave that way anymore.
Well, but Jim, that makes sense. I think we can understand that, and it's kind of been talked about off and on for the last several months now. But why is that going to push or help boost inflation to 2%? I think a lot of people are asking that question. Do you think it's going to change inflation expectations and people will suddenly pay more for things they're willing to? Or is it just to make sure you don't make the same mistake that many say you made in 2015, starting to raise rates too quickly?
Well, it's us as monetary policymakers, but it's also the shocks that are coming from the real world out there. And we've got a big one right now. And then if we react a little less aggressively to the shocks, then I think that will lead to higher inflation expectations, and we'll end up exceeding the target. And if there was ever a time when you thought that, maybe the ingredients for inflation are in place, you've got gigantic fiscal deficits combined with a more relaxed central bank and really rapid growth, off the charts rapid growth. So you probably will get some inflation, I think, even in the near term here over the next year. So I don't think it'll be quite as quiescent as it was before the pandemic.
You also said on Friday that you see, as many people do, this massive rebound in third quarter GDP. People are looking 25%, 30%, and you said it's another reason why it's going to help get inflation on track to 2%. I want to ask you a couple specifics about this, though. Doesn't look like there's going to be a stimulus package passed before the election, and hard to say when it will be passed after. What difference does that make, if any, to your forecast?
Yeah, I think that the original fiscal package that was passed in the March-April, several bills altogether, but the CARES Act in particular, that was really calibrated to a bigger shock than the one that has actually developed. We're certainly in a pandemic, and it's a big shock. It's causing a lot of disruption, but not as big as what they were thinking at that time. And so what we ended up doing is, borrowing 10 to 14% of GDP. But if you look at current forecasts for this year, it looks like GDP or national income, household income will only be down 3 to 4%. So you really borrowed quite a bit here to cover a hole, which now doesn't look like it'll be as big. So I'm hopeful that we still have enough in the pipeline to push us through, get the growth going in the second half of the year here. That certainly seems to be what's happening in the third quarter. I think that'll continue in the fourth quarter and the first part of next year. So I think we might be okay here. I don't think there's as much of an imperative about a new fiscal package as there might have been, in July as it might have seemed in August or July.
Well, are you referring to the imperative for Congress to do something? Maybe they don't feel it as much. Or are you also saying that given all the things you just said about the economy and the stimulus that was already passed, maybe it isn't as necessary as we thought? Many Fed officials have said more stimulus is needed, puts the recovery at risk if you don't get it. What exactly are you saying here?
So I guess my point is that what people were thinking was that 2020, at the end of the year, household income would be down 10%, 8% or 10%, something like that. And so we went out and borrowed 10% or more on international markets to try to cover that hole. But now it only looks like household incomes will be down 3 to 4% at the end of the year. And we still went out and borrowed 10%. So it seems like, at least in some broad macroeconomic type of calculation, we have enough resources to cover this. Now, of course, it's unevenly distributed, and there are many issues around exactly how it gets to the disrupted households, and that's very important. But as far as the total size of the thing, I think we might be okay, and we might be able to sustain a recovery through this winter.
I'm still not sure I understand how you think this is going to make inflation rise. After so long of not getting up to 2%, we still have some of the same old things. High unemployment, we've got slack in the U.S. and global economy, technology, the internet still helping to hold prices down because you can compare prices with everything. You can go on and on and on. You don't think that's going to stand in the way of 2% inflation, particularly when we're coming out of a pandemic?
The labor market linked to inflation has proven to be quite weak and getting weaker over the last 20 years. And so I think, one of the things I would stress is that it really doesn't seem like, labor markets go one way or the other, that really has all that much impact on inflation anyway. And then you've got all this other volatility going on with the huge disruption coming from the pandemic. So I'm hearing a lot from sources, contacts in the 8th District here about bottlenecks, supply chain mix-ups, even difficulty of hiring workers. All these things seem to be the kind of thing that you'd see in an economy where prices were going to go up, at least some of the prices were going to go up. So we'll see what happens here. I'm not saying this is for sure, but I think that the ingredients are there for more inflation. And then if, as Fed people, monetary policy people, if we don't react as aggressively as we might have in earlier eras, then that inflation will materialize and you'll be above 2%.
Well, let's ask the other side of the coin then, because as you say this, I'm thinking of, could inflation accelerate much more quickly than people are looking for? Less free trade potentially, as all these questions are raised between the U.S. and China and others. There's been a flood of liquidity from the CARES Act, the stimulus checks, the jobless benefits, loans to small businesses, Fed's big bond purchases, M2 money supply. You're a monetarist Fed, 20% so far this year. Home prices rising, stocks are correcting, but they had this monstrous rally. Is there tinder there that could really catch fire and maybe change those dots? Could there possibly be a rate hike before 2023?
Yeah, I mean, I don't, on the rate hikes, I don't think so, because the committee is essentially saying that even if that process got going, and let's not get ahead of ourselves here, it hasn't started yet, but even if that process got going, the committee would not react uh, as aggressively as we would have in the past. So I think, at least the initial reaction would be just to let that run and let that inflation process go and look through it for a while. And so, um, I think that's where we are, and we'll just have to see. But it's incredibly volatile times as far as macroeconomic data. These are unprecedented movements in a lot of the macroeconomic aggregates.
I'd like to ask you a couple of really specific questions. I think a lot of people certainly who follow this closely are asking. Moderate inflation overshoot. What's moderate? Average inflation. Jay Powell, Fed chair, kind of stepped back saying he didn't want to be too mechanistic or something. But I think, everyone's wondering, is it just a simple, how I would define, average 2%, or is it something like median versus something else? Are you guys still trying to figure that out?
Yeah, we weren't very specific on that, but I think it is a big committee, and you need to have Big Tent language. It's going to be a committee judgment about exactly how to define these terms. But I'll tell you, just from my point of view, we were willing to go with inflation being 0.5% below target for quite a while. It seems like you could go with inflation being 0.5% above target for a while if you wanted to get that to average out to be 2%. And then if you did that properly, then you would keep inflation expectations anchored right at 2%, and markets would understand that you're going to compensate for misses on the low side with misses on the high side. So, it remains to be seen whether we can execute that in the years ahead, but I'm hopeful that we can be successful.
We're all hopeful for you, Jim, and for us. But maximum employment, maximum inclusive employment, any definitions on that yet? And of course, a lot of discussion about if the Fed is, by putting inclusive, broader than just a specific number in there, if the Fed is perhaps pledging to do something that in the end they won't be able to do and set themselves up for a bit of failure and maybe a bit of blame down the road.
I've always felt that macroeconomics was about everybody in the society, and I've always viewed it that way and thought about it that way. And I thought the word inclusive was just helping us to reinforce the idea that we do care about the entire economy, and we want the entire economy to do well. And so I think it was good to reiterate that this isn't just a policy for certain people or certain firms around the economy, where we sometimes get blamed for that. But no, we care about everybody, and we want everybody to do well.
So what about quantitative easing? Jay Powell, well, actually, the whole statement, the presser didn't really talk about it. You kept the amounts of treasuries and mortgage-backed securities you're going to buy steady for now. So for you, Jim Bullard, what would make you think, oh, we have to raise it, decrease it? Where do you stand on that? I think that's another thing people are kind of curious about.
Yeah, we were a lot quieter about the balance sheet policy. I think partly that's because we're in a good place right now. We've got the at least language in. We've got purchases going on at a healthy pace, I would say, and we're still in the middle of the crisis. So I think all of that we're in good shape on. The committee has, in the last decade, been notably more quiet about exactly what the balance sheet policy would be, because it's harder to write down rules, and it's far more judgmental, I would say, than the interest rate part of the policy. And so that's why you don't see balance sheet projections in the SEP, and there aren't dots with the, on the balance sheet policy. And the committee has talked about that, but there just isn't enough agreement on the effects of those policies and the kinds of things that we'd want to report on those. And so we got to where we can get, I think, on that. And I think we have a pretty good policy right now, which is well understood by markets.
Jim, a final question here. We look back, in 2016, you sort of surprised maybe even other people at the Fed, but certainly the world of Fed watchers, when the Fed had already started raising rates, and you said that, wait a minute, you didn't see any rate increases until there was a regime change of some kind to really shift the economy, right? And back then, inflation targeting was meant to prevent inflation from moving too high. Now the Fed has said, well, we're going to let it run. Are you maybe adopting this at just the wrong time, just as the Fed started targeting inflation just when you didn't need to keep it low, you needed to push it higher?
We named the inflation target in 2012. I think the idea there was to get more credibility and maybe move inflation up by naming the inflation target. That isn't what materialized over this era. But I would just say for the viewers here that I think the main issue is just the appreciation of the effective lower bound on interest rates and the appreciation that that is causing a distortion in actual inflation outcomes, is pulling inflation down more than we would like. It's making us miss our inflation target to the low side. So that's what we want to get rid of here. The whole idea of inflation targeting was developed in a world where people didn't think about the zero lower bound. They didn't talk about that. That wasn't part of the equation. It would be like doing the orbits of the planets, but forgetting Jupiter or something like that. I mean, you'd have to recalculate everything. What we've learned is you have to fix that with this new policy. So I hope we're making a good push in the right direction here to get inflation to 2%.